Let's start up. Let me share the lesson guide for the day. Okay, today we are considering learning unit 5, property, plant, and equipment, PPE. Property, plant, and equipment, IS 16. You have all these overviews. You can go through how this overview. To save our time, I just want to start from the definitions. Okay. Let's look at the following terms as it relates to PPE. We are going to be coming across these terminologies as we discuss this particular topic. We have carrying amount. Carrying amount is the amount at which an asset is recognized in the statement of financial position after deducting any accumulated depreciation and accumulated impairment losses. So when you say carry amount, it's just the book value of that particular asset in your book, in the books of the organization. You know what is depreciations. Depreciations is the wear and tears of that asset. So every asset depreciates. When you have an asset, you will determine what is the useful life of that asset. Okay, so when you determine the useful life, if you have an asset that, okay, the useful life is 10 years, 5 years. Let's take a motor car, for example. A motor car useful life normally is 4 years. That is under some companies sometimes might decide to depreciate their motor vehicles in 3 years. Okay, so when you know the useful life, then you divide the useful life. You divide the amount of that particular asset by the useful life. So which means every year, some part of the values of the asset will have been eroded. So which we call depreciation. So in any given, if you have a car this year and this financial year, the following financial year, some amount of the value of that car will have been depreciated. So you remove it from the total value you have in your books. So the remaining value is what is referred to as carrying amount or the book value. Okay, so we are going to see those terms as we go on. Bridget.
Good evening. Are you sharing something on the screen because I'm unable to see anything?
Oh, guys, can you see?
Yes.
It's only Bridget that is not. Bridget, I think you are the only one that is not seeing. What you need to do, maybe you go out and come in and come back.
Doctor?
Yeah?
Okay, I'll try. Thank you.
Okay. Yeah, Mr. Matibula, you are talking to me? Okay, guys, can we continue? Bridget, you can lower your hand.
Dear students, most of them are complaining that, like, before it is your.
Hello. Okay, can we continue? Then you have cost. Cost is the amount of cash or cash equivalent paid and the fair value of the other consideration given to acquire an asset. So when you acquire an asset, the amount of money you pay, it's either you pay money for that particular asset, or there's an exchange of other asset that you have taken in the place of the asset, in the place of asset that you are acquiring, there's a considerations you are giving up for you to acquire that asset. So that asset will be valued also, and that is the cost. So that is the cost of that asset. And that is the cost. You will measure, normally you measure an asset initially at cost. Then other subsequent measurements can either be at cost or at a revaluation value. So we are going to see all those ones. Then depreciable amount. So that is the cost of an asset or other amount substituted for cost less the residual value. Okay, so when you talk about depreciable amount, you are talking of the cost of the asset or other amounts substituted for the less residual value. What is residual value? The residual value is when an asset is fully depreciated, whatever value that can be recovered from that asset is what is referred to as residual value. For example, if we are talking of a motor car, if you have a motor car and the useful life is 4 years, and that car after 4 years has been fully depreciated. So ordinarily in your books, the value of that asset is 0. In your financial record is 0. But if you sell that asset, if you determine the market value of that asset, that is, you take such a car to the market and you're able to still recover something on that particular asset. That is residual value. The residual value, that's what is referred to as a residual value. So when residual value is removed from the cost of asset, then you refer to that whatever you have as a depreciable amount. Okay? Then you have depreciation itself. Is the systematic allocations of depreciable amount of an asset over its useful life. The systematic, so the amount, like I said, the useful life of an asset, when you divide the total cost of that asset by the useful life, you now know the amount of depreciation per year. Okay? So that is depreciation. Depreciable amount is just the total cost less residual value. Residual value is a recovery amount you can make after the asset has been fully depreciated. Then you have residual value, the estimated amount that entity will currently obtain from a disposal of an asset after deducting the estimated cost of disposal if the asset were already of age and the condition expected at the end of a useful life. Useful life. This is either the period over which the asset is expected to be available for use and the number of productions or similar expected to be obtained from asset by the entity. So these are various means of determining the useful lives, okay? Recognitions of property, plant, and equipment. How do you recognize them? I think through you should know the recognition criteria from your conceptual framework. I believe you will have done that. Conceptual framework, you have there you have the recognition criteria. How do you recognize an asset? Asset must have a future value. That is, there must be an inflow from that asset, and it must be measurable. These are criteria that are listed in the conceptual framework on how you can recognize an asset. So when you have to be familiar with that, so that when you see a question you will know whether you'll be treated as an asset or not. If it doesn't have the recognition criteria of an asset, then it cannot be asset. It can only be asset when it meets up with the criteria of an asset. Okay? All this you can just go through because of our time. We have a lot to cover today. Okay, so these are just, we talk of initial cost. Sometimes entities are obliged to acquire certain PPE items for safety or environmental reasons. Although such an asset will not directly give rise to increased future economic benefit embodied in the specific asset itself, the entity is obliged to acquire such an asset for increased future economic benefit from other assets. Consequently, these assets are capitalized. The resulting carrying amount of such an asset and related asset is reviewed for impairment in accordance with IAS 36. The calculation of impairment does not form part of this module, okay? So talk about initial cost. Initial cost is the cost of that particular asset, taking into considerations all other traceable cost. We are going to see the details as we go on of how you determine your initial cost of an asset. Okay. Just all these preambles, you can go through them and we'll just concentrate on try to see how many examples we can resolve before our times is up. So we have an example 1. It's saying to comply with environmental requirement, a manufacturer of chemical products has to install a new chemical air filter to prevent the emission of toxic gases. The relevant values at the year-end 30th April 2010 were as follows. We have the existing plant. The cost of the existing plants is 5,000. The accumulated depreciation is 1,250. Then the carrying amount on 30th April 2010 is 3,750. Then the cost of the air filter, which is available for use on 30th April, so just like an addition, is 800. The net carrying value on 30th April is 45. The air filter are additional costs to the plant because the entity is obliged to acquire it for increased future economic benefit from the plant. Therefore, it is capitalized. Okay, let me just explain what this example won't try to show us. You know, when you talk of plant and machinery, there are some other costs that will come along with it or that will be incurred in the cost of using that equipment that may be capitalized. Capitalized in the sense that, I mean, what do you mean by capitalized? That is, you are going to add the value of that particular, it can be spare parts, it can be, you know, part of something that is, it can be an adjoining part to that particular asset before it can be usable. So such an asset, you will add it to the value of that asset. It will make up the total cost of that asset. But some are, when you look at some of those expenses, some of those things you buy, it might not be really considered as an addition. It can be just in form of repair and maintenance. So now, how do you determine which one to capitalize and which one not to capitalize? That is what this is proving to us, that it must be that the asset must increase the future economic benefit of that particular asset. So that's why they have to show us an example here that, look, there's an existing plant here, but there's also a filter to prevent the emission of toxic gases. So they have seen this filter here as a component that will increase the future benefit of this particular plant. So such amount of this, and because of the importance of that, we cannot classify this as a repair and maintenance, because normally when you say you buy a filter into a plant, a filter can just go as an expenses and go to your P&L instead of capitalizing it. But now you have to look at the questions to see if that particular part or that particular expenses you are incurring will lead to increase the future benefit of that existing plant. So that is your major condition for either capitalizing it or not capitalizing it. Okay, that's the example I've shown. They've seen that you can see the cost of the filter to be 800,000. And they have seen this filter as a very important component in the plant that will also increase the future benefit. It will maybe extend the life of that plant, thereby bringing about increase in future benefit of that plant. So that amount have to be capitalized instead of expense it straight to P&L. Okay, so that is the explanation here. We just have to note that as we go on, okay? You talk about subsequent costs, servicing costs, the normal day-to-day servicing maintenance costs of PPE item are not recognizing in the carrying amount of the item, but in the profit and loss. This is what I've just explained. If this is a service cost. So, and the expenses is described as repairs and maintenance and consists mainly the cost of labor, consumables, and small low values. Okay, so if the value is low and the value is related to labor and consumables, such will not be capitalized. Then replacement at regular interval. Part of PPE item may require replacement at regular interval. For example, the relining of furnace, the seat and galleries in the aircraft, the interior walls of buildings such as an office block. The principal main asset like a furnace, aircraft, and building has much longer useful life than the respective component, like the relining, seat, and interior wall. So an entity recognized in the carrying amount of PPE the cost of replacing part of such an item when that cost is incurred if the recognition criteria are met. If the recognition criteria are met, and one of the recognition criteria is that it must have future benefits. So the remaining carry amount of the replaced part is then recognized. Okay, go through all these stories. I'm sure by the time we are solving problems, then they'll become more clearer and clearer. These are just theories. When you see it practically, when we solve problems where all these things are taken into considerations, then I believe you will have better understanding. Okay, let's look at example 2. Dean Limited purchased a machine on 1st of January 2012 for 1,600. The machine has to be inspected. The machine had to be inspected every 6,000 hours, which means that a major inspection will have to be carried out every 2 years. So the last inspection performed on the machine was on 31st December 2011. Let me just mention this, that in PPE, when you are dealing with PPE, property, plant, and equipment, date is very important. So when you are reading your questions, be mindful of the dates. They are very, very key to your calculations of either depreciations or additions and all that. Your date is very, very important. So you have to be mindful of the dates. This Limited purchased a machine on 1st of January 2012 for 1,600,000. The machine has to be inspected every 6,000 hours, which means that a major inspection will have to be carried out every 2 hours. The last inspection performed on the machine was on 31st December 2011 by the seller, and the inspection cost was included in the purchase price. The inspection cost was included in the purchase price. On acquisition date, the present value of the future expected inspection cost to be incurred was estimated to amount to 150,000. Okay? This machine have to be inspected every 2 hours, every 2 years. Now the first inspection has been done and the price has been added to the purchase price according to the question. And what the estimated cost of that inspection is 150,000. Okay. Now, on acquisition date, the estimated useful life of the estimated useful life of 8 years was allocated to the machine. So the machine has 8-year useful life. You can see now there are two scenarios here. The machine has 8 years useful life. The inspection itself, the inspection has 2 years useful life because it has to be carried out every 2 years. So it means the lifespan of that inspection is 2 years, but the lifespan of the machine itself is 8 years. Now the question is saying, calculate the depreciation and the carrying amount of the machine for 2012 and 2013 if everything goes according to plan. B, due to several factors, the inspection needed to be done after 20 months. Due to several factors, the inspection needed to be done after 20 months instead of the planned 2 years. And the cost of the first physical inspection amounted to 200,000. Show how this matter will be disclosed in the property, plant, and equipment note for the year ended 31st December 2013. The machine is the only asset of the entity. Okay. So the question is in two parts. We are to calculate the depreciation and carrying amount of the machine for 2012 and 2013. Now let's look at the solution. Let's look at the questions. A was asked us to calculate the depreciation and the carry amount of the machine for 2012 and 2013. Okay. Anyway, this is just to calculate the depreciation. By the time we get into PPE proper, then I will try to explain the format, the usual format we need to familiarize ourselves with, that you'll be using to resolve question on PPE. Okay, but here we are we are building our momentum as to where we are going. So let's keep following. So to calculate the depreciation, what here, for easy understanding, or for easy understanding, for you to be able to handle those informations very clearly, you know, you can see the study guide here. We're able to separate the machine and the special component. Okay, for easy calculation. If you can handle it without separation, fine. But here is just to ease your calculation. So because we were told in the question that the last inspection performed on the machine was on 31st December 2011 by the seller, and the inspection cost was included in the purchase price, and the purchase price is 1,600,000, and we were told that the purchase price is estimated to be 150. Okay, these are the informations we have, and now here for you to be able to handle it, to calculate it, you have the machine, you have the column for machine for inspection and the total. Okay, so when you remove 150 from 1,600,000, it means the actual cost outside the cost of the inspection is 1,450,000. The cost of the inspection is 150. The total is 1.6. Now the depreciation for 2012, because we were asked to calculate depreciation for 2012 and 2013. Now the depreciation for 2012. What is the depreciation for 2012? You know why this, why separating the cost really help you now? You can see that we have two different useful life. You know the formula for calculating depreciation, I've told you the other time, is the cost of the asset less residual value, if it is available, then divided by the useful life of that asset. That is the formula, okay, for determining depreciation. The cost less residual value divided by the useful life. Now, if you want to apply that formula now for our depreciation for 2012, the cost here, the cost of the machine, is we will not use 1,600 because we have two different useful life in the question. That is why this separation will make it much easier for you. So the cost of the machine, the cost is 1,450,000. And its useful life, because there's no residual value in the question. So the useful life is 8 years. So you divide the cost by the useful life. So it gives you 181,250 per year. So you have the depreciation. So 181,250, that is the depreciation per year. So for 8 years, then the asset will be 0. Okay? Now, for the inspection component, which is 150, we were told that the inspections will only have a useful life of 2 years. It will only last for 2 years. So the depreciation will be divided by 2, the useful life. Okay? So you now have the cost of the machine, you have the depreciation for the machine, you have the depreciation for the inspection. Then the total depreciation is here. We have the total cost here, 1 million, the total depreciation is here. Okay? So when you subtract it from the cost and the inspection cost, you have the carrying value on 31st December. Okay. And depreciation here, since we are not told that it is on reducing balancing method, so we have reducing balancing method, and we have straight line method to calculate our depreciation. But here, we assume it's a straight line method, since we are not given any percentage that will be used for reducing balance. We have the cost. When you have the useful life and you have the cost, and that is straight line method. So depreciation for 2013 now, you have already calculated it. That is what will be depreciating every year. It's the same amount. So you put the depreciation there for 2013, that of inspection component, and you can see just for 2 years, then that inspection component will be fully depreciated, it will be 0. So this is the carrying amount of their asset on 31st December 2013. Okay, so you have answered question number 1. You see the lecturer's comment here. I said the inspection component is part of the machine and it's not a separate asset. You separated it for easy, calculation, for you to make easier for you to be able to determine the right calculations. Okay. Any question? Are we okay up to now?
We are fine.
For a question, Doctor.
Okay.
Just a quick question. So, 150,000 was inspection, and it was divided in 2 years for 2012 and for 2013. So the stated that every 2 years inspection has to be done. So if that's with 2014 as well, with another 75,000 decrease from the machine value, apart from the 181,250 depreciation.
Jovian, come again. You said the special cost has been depreciated. It's for 2 years, and we have depreciated for 2 years now.
Does it confirm with regarding the inspection component?
Yes.
So every 2 years, 150,000 gets deducted, meaning 75,000 per annum.
Yes.
So,
yes.
So on the following period, in 2014, with another 75 come be deducted, apart from the 181,250. Am I correct in saying so?
No, okay. On 2014, our depreciation for machine will still be 181,250. It now depends if the inspection is carried out. The question will be, will lead us to know whether the inspection is carried out, and if it's carried out, is it still the same amount? So you will react based on the questions you have. As per these questions, we found out that the inspection is for 2 years, and the question asks us to limit our depreciation and carry amount calculation to 2 years.
Okay, understand, Doctor. Thank you so much.
All right. So let's look at the second question that says, if due to several factors, the inspection needed to be done after 20 months instead of a planned 2 years. You can see now something has changed here. You know, they told us initially the inspection is planned for 2 years, but now they said because of some factors, it has to be done now after 20 months. So it's no longer up to 2 years anymore. Have to be done. And the cost of the physical inspection amounted to 200,000. Show how this matter will be disclosed in the property, plant, and equipment note for the year ended 31st December 2013. The machine is the only asset. Now let's go see how we go about this one. Now, the note, the limited note for the year ended 31st 2013, note 5, property, plant, and equipment. Okay, we see the carrying amount on 1st of January 2013 because our note is ending 31st 2013. So it means if the financial year is ending 31st December 2013, which means it begins from 1st of January. You know, it's 12 months, January to December. So the carrying amount now the gross carrying amount of that asset is 1,600. The accumulated depreciation that we have, if you come to your depreciation you have calculated, you will see that the accumulated depreciation we have 250. That's the depreciation we have. 250. That's the depreciation we have. The total cost is 160. Then it means our carrying amount on January 31st, 2013 is 1,347,50. Then the depreciation for the year. The depreciation for the year, you see it in bracket, the calculation of the depreciation for the year. Because the scenario has changed now, let's see how we calculate our depreciation for the year. Because now the initial inspections duration have changed. The cost has also... Hello, please, you are disturbing the class. Okay, let's look at the calculation we have. Now, the depreciation, we want to look at the depreciation for the year. The depreciation for the machine itself, you know, it is 181,250. That is the depreciation for the year, the one we have calculated. Now, the depreciation for the inspection. We are told now that for inspection that's supposed to be 2 years, it's no longer 2 years. It's now going for 20 months. For 20 months. Okay? So you have to recalculate that. It's now going for 12 months. You know, initially you divide 150 by 150 by 2. We have 75 for each year, but it's no longer 2 years now. And if it's no longer 2 years, let's look at the period. Look at the period. The first inspections. You have, I think you have used a complete period there, one financial year. It is only the second one because 20 months is 1 year. 1 year, 8 months. Yeah, 20 months is 1 year, 8 months. Okay. Now, 1 year have gone. The other year now will not be fully depreciated. we have to depreciate it for just only 8 months. Okay? Now that is what is done here. You have the depreciation. The initial depreciation is, the initial inspection is 150 divided by 2 multiplied by 8 months. Okay, that is the initial inspection, because the initial inspection of 150, part of it also is part has been fully depreciated, 75% have been gone. The other 75% now is no longer covered for 12 months. It will only cover for 8 months. Okay? It will only cover for 8 months, which is when you calculate 150 divided by 2 times 8 months, or 75 times 8 divided by 12 will give you 50. Now, the new inspection is the depreciation of the new inspections will cover for the remaining 4 months. We cover for the remaining 4 months. So the new inspection cost is 200 with divided by 2 multiplied by 4. 4 months, remaining 4 months, then you have 33,300. Okay? So if you look at this note 1 here, inspection of the machine is carried out after 20 months. Therefore, the first 12 months fall within the 2012 financial year. That one has gone. The remaining 8 months is in the now current year, which is 2013 that we are working on. Okay? 1st of January to 31st of August 2030 is 8 months. So the depreciation period for initial inspection cost. 1st of September to 31st December 2013 will be 4 months. That will be depreciation period for the new inspection cost. Okay. So this is how you determine the depreciation, the new depreciation for the year. So that is what we have here, 264.83. Then the recognition of initial inspection cost. The recognition of initial inspection cost. What is the recognition? Before now, we used to call it disposal, but we no longer call it disposal because, okay, for example, this inspection now we are not disposing anything, but we are derecognizing it. Okay, you know, the calculated depreciation for the year is 75,000, but now for this current year, 2013, it's no longer, we are only going to recognize only 50,000. So the remaining 25,000, we have to be derecognized. We have to be, that is to be removed from the books. So that is why it's a negative. We have already, because the useful life is 2 years, it is 75. But because of what happens, other factor that comes in, the inspection was done earlier before schedule. So they now determine the depreciation based on the number of months that the initial depreciations, covered. And now the new depreciation is 50,000. So the balance of that initial depreciation will be derecognized. Okay, Adele, your question.
My question, sir, I got confused a little bit when it goes to the calculations. Okay.
Okay.
Yes, I understand the 150 divided by 2 multiplied by 8 over 12, and then I understand 4 months was left before it becomes a full year. But where is this 200,000 coming from? Why are we using 200,000? I'm not, maybe,
okay.
Unless maybe there's something that I skipped.
Okay.
I didn't understand.
No, you see the 200,000 is here. Let's look at the requirement. Requirement number B. Okay. It said, if due to several factors, the inspection needed to be done after 20 months instead of the planned 2 years, and the cost of the physical inspection amounted to 200,000.
Oh, yes.
Okay. So now, though the useful, the inspection, the standard inspection period is 2 years, but now they because they said due to several factors, they have to do it earlier before 2 years. So because they have to do it earlier before 2 years, the depreciation initially calculated is for 2 years, 75, 25. But now we can see that because of the situation that arises, we can't use all the 75,000. We can only absorb only 50,000 because of the situation that occurred, because now the 75% will only be usable for 8 months in the year. Because now that it has to be, the inspections was carried out 4 months short the original scheduled period. Okay, 4 months short. So it's only eight months. We have to calculate the 8-month part of it. We have 50,000. The remaining four months will now be based on the new inspection cost. Okay. Then the balance of it, we have to be recognized from the books. Then capitalization of the special cost incurred. You know, the new inspection cost now will be added to the asset. Then the carry amount on that for December 2013 will now be 1,254,167. That is, this is the gross amount now. 1.6 million minus 150, the special cost earlier. You have to take it out. Then you have to bring in the new inspection cost. You can say you bring in the new inspection cost. Then your accumulated depreciation now, 250 you calculate plus the current depreciation we calculated now, which is 264.83, then minus 75. Minus 75, then minus 50. Minus 75. So your accumulated depreciation will be 395,833. Okay. Then you will, this is how you will deal with question 2. Okay, this is how you will deal with question 2. But we are going to see more comprehensive questions, and it will be much, much straightforward. Okay, this is just to building our momentum towards where we are going. But this is how normally you will deal with, when you're talking of PPE, you'll be talking about the cost, the carry amount at the beginning. Then you talk about if there's a revaluations, if you're talking about if there's additions, you talk about depreciation, current depreciations, you talk about the recognitions and the carry amount at the end of the financial year. So this is the format, I mean, almost similar format is going to take. Okay. But when you have a scenario like this, that's what I'm saying, when you are the questions will determine what actions you are going to take. So read the questions, especially the date. Be mindful of the date and see what happens when and when. Like when 2 years now change to 20 months, you have to know that the depreciation that you have calculated for a year will have to be prorated to take care of the time the initial one will stop and the time when the new one will begin. Okay. Yeah, let's go ahead. We'll see more questions and more comprehensive ones. Then you will begin to get better understanding. Measurement at recognitions. Then this year is, I mean, talking about element of cost. The cost of PPC comprises of, we studied this one in the last class when you say cost of inventories, what are the other costs that is attributable to bringing them to the locations. These are the same thing. When you talk of an asset, there are other direct costs. I mean, direct costs that will need to be added to it, to the actual purchase price, if they are those costs that are directly attributable to bringing the asset to the location and condition necessary for it to be capable of operating in a manner intended by the management. Okay? Then we have some example of that. These are example of direct attributables. Just let's go them. This is as applied to IS2 inventory, which we discussed last week. You can go through all these ones and okay, this is an example to discuss. I mean, examples to emphasize on the discussion above. So let's go through the examples. Example 3. Aviation Air Limited is a private aviation company in South Africa. The company has a 31st December year end. Building, Wonder Boom. On 1st October 2017, Aviation Air Limited signed a rental agreement to rent a vacant piece of land for a period of 30 years from Wonder Boom Renters. Wonder Boom Renters agreed that Aviation Air Limited may erect an office and aircraft hangar on the land, but require dismantling of the building at the end of its useful life. Okay? He said, okay, you can build structure on the land, but you have to dismantle it after the expiration of that lease. Okay, on 1st of January 2018, Aviation Air Limited started with the construction of an office and aircraft hangar on the Wonder Boom land, which was completed on 30th June 2018 at a total cost of 2,279,500. On 30th June 2018, a total useful life of 29 years, which remained unchanged throughout the period, were allocated to the building. The building were available for use as intended by management, as well as brought into use on 1st July 2018. 1st July, the building were available for use as intended by management. So this date is very important to you. That is the date that the building were put to use on 1st of July. Then on 30 June 2018, the present value of the future expected and the estimated cost of dismantling and restoring the site on which the building are located was determined to be 12,666. Okay, if you understand the question, it's saying, now, the cost of the building is 2.2 million. Now, the cost of dismantling it, you remember that he said, okay, whatever you build on this land, at the end of the lease, you must dismantle it. So the cost of the future expected cost to dismantling it is 12,666. All right. Now the question is asking, calculate the total cost of Wonder Boom building, the office, and the aircraft. Before we look at the solution, who can just tell me the answer? What is the total cost?
It's 2,292,166.
Okay, you added the cost of dismantling plus the cost, right?
Yes.
Yeah. Because the cost of dismantling plus the cost of the, that's why I say if you read all the stories up here, you will see something like that. That the cost of example of direct cost of employee, initial handling, installation and assembly cost of testing whether this performing, example of costs I do there's something like that. I think just read it carefully. I think the cost is the cost is there. The cost of dismantling is part of the. I mean, it's called part of the cost that is traceable to the cost of that land. Okay, so you are correct. You just add the cost of dismantling there. Now, another aspect is talk about capitalization of depreciation. Capitalized depreciation. So let's look at situations when you can capitalize. You know, depreciation is an expenses that you charge to P&L. So, I mean, how do you capitalize it now? Capitalizing means you are going to add the cost plus the cost of that asset. So let's see, I mean, how it can happen. Let's look at this example 4, how that one can happen for you to now add the cost of depreciation to the cost of asset. Okay. X Limited withdrew a crane A from its normal construction operation for the period 1st October 1903 to 31st December 1903 and use it in the construction of a new plant which was commissioned on 1st January 1904. X Limited financial year ended 28 February. Okay. Crane A at cost is 200,000. Crane A at the carry amount of 1st March 1903 is 100,000. Depreciation. Crane is 20% on reducing balance. The plant is 2% fixed installment method. The cost of the new plant is 550 before capitalization of depreciation. The questioner is now saying, show the journal entries, profit before tax note and property, plant and equipment note in the financial record of X Limited for the year ended 28/2/1904. Okay, so if it is 28/2/1904, it means the financial year will have started 1st of March. Okay. Now, let's see, what you need to take note here is that Crane A is working in a place before. Crane A was working a place before. So let's assume that because the financial year start from 1st of March, okay? Now, Crane A is working in a particular site before. Now the crane was withdrawn for the period of 1st of October 1903 to 31st December 1903 was withdrawn in this period. This is October, November, December, and use it in the construction of a new plant which was commissioned. So I think that is where we need to take note.
Someone is crying.
So that is where we need to take note. It was withdrawn. It means it couldn't complete that particular financial year in that former site. Right. Okay. Now, let's look at the total depreciation of Crane A. The crane is to be depreciated using, okay, Safila. Safila, your question. Oh, is that and a mistake? Okay, let's go on. So the question says the crane should be depreciated 20% on reducing balancing method. Now, the carrying value of that the carrying value is 100,000 according to the question. The carrying value on 1st of March is 100,000. You know, when you are using reducing balancing method, I don't know whether you will have done it in your normal class. When you are using reducing balancing method, you are calculating the percentage on the carrying amount. But if it is straight line method, you are using the cost value. But if it is reducing balancing method, you are reducing balancing method. That is, the cost is 200,000. It has reduced to 100,000 as at 1st of March. So when you are calculating another one, you are also determine the percentage on the carrying amount, not on the cost. Okay? So the percentage, the 20% of the carrying amount is 100,000. So it's 20,000. So it's supposed to be 20,000 for a year. Okay? The depreciation should be 20,000 a year. If you know, from 1st of March, this is the carrying amount. So 1st of March to 28th February 2004, that will be full financial year. Okay? So 1st of March, the carrying amount is 100,000. The depreciation for the year should be 20% multiplied by 100,000, which is 20,000. Which is 20,000. Now, because at a particular time of the year, the crane was withdrawn. The crane was withdrawn from that site. So the crane was withdrawn to go and work on another new plant. Okay, so that 20,000, you have to remove the value. Hey, Kadimo, you are disturbing the class, please. Okay, so it's 20,000 for the whole year, which is for 1st of March to 28th of February 1904. But because the crane couldn't work for the entire 12 months, it was withdrawn for 3 months between October and December. So you have to calculate that period and remove it from the total depreciation. You can see that the depreciation capitalized now, they said 20,000 for 3 months. That is 1 so you calculate 20,000 multiplied by 3 divided by 12. So that amount that relates to that 3 months when the crane was withdrawn, you take it out. Okay? It means the depreciation that will be charged in respect of that crane in its previous working place will only be 15,000 because for these 3 months the crane has been withdrawn, and you have to remove the depreciation that is relates to that period. So if you have so this 5,000 there, which should have been a depreciation if it is not withdrawn, that particular cost will now take it and added it to the cost of the cost of the new plant is 550. That is the cost given in the question. Now the capitalized depreciation is now 5,000. The total cost is 555. Okay. Now you are now depreciating the plant 555 multiplied by 2% for 2 months because the cost of the new plant was purchased the cost of the new plant is 550, and you know that the new plant was commissioned on 1st of January. 1st of January 1904 to 28th February will be 2 months. So the new plant is actually in existence for 2 months in the financial year, and the rate is 2%. Okay, so you now calculate the rate. So what this example try to emphasize here is situations where your depreciation can be capitalized. That depreciation should have been an expense if the crane works entirely 12 months in its previous place, but the crane was withdrawn and now have to come and work in this new plant. So the cost of that, the depreciation value of that crane at that moment will be considered as additional cost of the plant. Okay. Do we have any questions? This is just a rare case. In case you come across it in any of your questions, this is how you address it. Okay. Let's run fast. Is there any question? Okay. Then these are the journal entries. Depreciation 20,000, accumulated depreciation for the. These are normal. Your plant. This is the plant. You debit the plant because you are adding the depreciation. Then and you credit depreciation. That's it for the 3 months multiplied. This is the current depreciation. You debit depreciation, credit accumulated depreciation. Then this is your income. The entire depreciation you have to credit to. I mean, you have to debit it to income. You know, depreciation is an expense, so you debit into your income statement, and this is the note to depreciation calculations. How you calculate the depreciation, the current depreciations. The carry amount depreciation for the year, 15,000 depreciation capitalized. The carry amount, the cost. Okay. Yeah, measurement of cost, abnormal credit terms. We are going to abnormal credit terms. We are going to. There are occasions that this one will come up. Sometimes the cost of PPE item is the cash equivalent at a recognized date. But if the payment is deferred beyond normal credit times, the difference between the cost price equivalence and the total payment is recognized as interest over the period of credit. Okay? And however, capitalization of finance cost does not form part of this model. So we will not really bother ourselves. But what they are saying is that, sometimes you may purchase an asset and you may not pay for that asset immediately, or you may not pay the total amount immediately. And if the credit period is usually, if it is beyond normal credit period, normal credit period at times is just 3 months. But if you're having it defer beyond the normal credit period, then the issue of interest will come in, and then you have to be calculating present value of such total interest and all that. But now it's not part of this model. So then these other ones, we also look at it as also some preliminary knowledge we need to know about PPE is that the exchange swap. There are also some conditions here you need to understand in case you have questions on something. On exchange. One or more PPE items may be acquired in exchange for monetary or non-monetary asset, or a combination of both. Okay, the cost of the acquired item is measured at a fair value unless the exchange transaction lack commercial substance, or the fair value of neither the asset received nor the asset given is reliably measurable. In both cases, the asset that is acquired is measured at the carrying value of asset given up. Now, let me just explain this so that we will not waste our time. There are situations that you want particular asset, but you are not going to pay for that asset using money. You might want to exchange another asset. Okay, you want a vehicle, particular vehicle, and you want to also exchange either computer, either plant, either whatever machineries you are going to exchange in getting that vehicle, or you are going to exchange plant in getting another plant. You are not paying money. So that is what they are saying here. But they now say, how do you measure them? How do you measure such? If you collect plant from company A and you give out motor vehicle in exchange, how will you measure that plant you collected in your books? What is the value are you going to record in your books? Then the other company, what value is it going to record in this book for the asset collected against the one is given out? So this is what he's saying here. And these are conditions. They are saying the cost of the acquired asset is measured at a fair value. Normally, the questions will tell you whether there's a fair value. A fair value is a value that is, market related. And that is market is going to be acquired, measured at a fair value. We are saying that the cost ordinarily should be measured at a fair value, but there are conditions to it. Unless if the exchange lack commercial substance. What is commercial substance? If the exchange is not going to add any value, any reasonable value to what you have before. If you are exchanging, an item that have the same, maybe the same value, the same condition, it's not adding any value to you, then again, if the fair value of the asset you are receiving, or the one you are giving out is not reliably measurable, if the questions indicate that it is not reliably measurable, it means that the asset that you acquire will be measured at the carrying value of that asset, of the asset given up. The asset you acquire will be measured at the carrying value, that's the book value of the asset you're giving up. For example, if the asset you acquire is 60,000 and the book value of the asset you are giving out is 50,000, and these conditions exist, that is, the exchange lacks commercial substance, and again, the fair value of those assets cannot reasonably be determined, then you are going to measure that asset you acquired in your books using 50,000, which is the carrying value of the asset that you are giving up. So that is the story here, okay? So that is the story here. Let's go through, I think there's an example to explain it. Then you will understand, you will better understanding it. I'm just looking at our time. Okay, let's look at example 5. I believe that you understand the explanation. Now, Bob Limited entered into the following exchange transactions during the year ended 31st June 2010. Okay? Now, transaction 1, a motor vehicle with a carrying amount of 100,000 in the record of Bob Limited and a fair value of 120 was exchanged for a light delivery vehicle of SAS Limited with a fair value of 125. The fair values of both vehicles can readily be determined since there is an active market for used vehicle. Now, with what I've explained, in the books of Bob, a motor vehicle with a carrying amount of 100,000 in the record of Bob and a fair value of 120 was exchanged for a light vehicle in the book of light vehicle of SAS Limited with a fair value of 125. The fair values of both vehicles will readily be determined since there is an active market for used vehicles. So the fair value is readily determined. Okay, so based on what I've explained now, I want someone to just try and provide an answer. What will be how will the Bob Limited measure the light vehicle that is acquiring? What will be the value of that light vehicle in the books of Bob?
I'm going to take a chance here, but I would say that it's 105,000.
Yeah, let's.
At 120. Shouldn't it just be 120 and then there's a difference of 5,000 or 5,000? That would have end.
No.
I
like
an accounting amount.
Yeah, I like your attempt. Now, let me explain the condition. The condition we have here. Once you know the condition, you just go straight to the condition you have here is that one or more PP item may be acquired in exchange for monetary or non-monetary assets, or a combination of both. The cost of the acquired, just underline that acquired, the cost of the acquired item is measured at a fair value. It's measured at a fair value unless this condition exists, that is, the exchange transaction lack commercial substance. I've explained what it means to lack commercial substance. That is, it doesn't have any added value, even to the company. More than the asset that they are given out. Then, if the fair value of the asset received nor the asset given out is not reliably measured, in both cases, the asset is acquired, is measured at a carrying value. So, which means if this condition does not exist, you are to measure the acquired asset at a fair value. You understand it? But if these conditions exist, that is, if the transaction lacks commercial substance, if you cannot determine the fair value, then you have to measure the acquired asset at a carrying value. But if this condition does not exist, you have to measure it at a fair value. I want you to use the understanding. Let's go back to the question again. You know, in these questions, none of these conditions exist. We are not told that the exchange lack commercial substance. We were not told that, because even the question told us that the fair value of both vehicles can readily be determined since there is an active market use. So which means the acquired vehicle is to be measured, will be measured using the fair value. So based on that now, which value are we going to measure the acquired vehicle with? What is the fair value in this question? What is the fair value of the acquired vehicle? Okay, which vehicle that is acquired? Hello? We can see that Bob acquired a light delivery vehicle.
Sorry?
Hello?
Is it not the 125,000?
Yeah, it's not the you are not going to use the fair value of the vehicle, the fair value, the company, the fair value, you are going to use the fair value of the vehicle that you are given out. For the vehicle you acquired, here the Bob acquired a light delivery vehicle, which has a fair value of 125,000. But the vehicle that is given out, the motor vehicle that is being given out, has a fair value of 120,000. Okay. I know when you read this thing, you understand what I'm saying.
Sir?
The cost of acquired vehicle is measured at a fair value. The fair value of the asset that you are giving out, you are giving up. Okay? This Bob is
Okay,
giving up
understand.
a motor vehicle, and the motor vehicle fair value is 120,000. Is that clear?
Yes.
Yes.
So when he collects this light vehicle from SARS, in his book, he's not going to record the value that SARS put on his vehicle. In his vehicle, based on those conditions, based on the dictates of this IAS 16, paragraph 25, 26, he's not going to use the value that the SARS put on his vehicle. The standard recommends that he will use the fair value of the vehicle, of the item given up. Is that clear?
No.
Aha. So
Yes,
Bob
it's
is
clear.
giving up a motor vehicle which has a fair value of 120,000. But the standard says if we cannot determine the fair value, or if the exchange lack commercial substance, it means Bob will determine the value of the vehicle that is collecting using carry amount of 100,000. Is that clear now?
It makes sense to me now. Thank you.
Yes. So what you have to ignore the value that the other company place on it. The standard is saying that once it is the fair value of the asset that you are given out, if it is determined. But if it is not, you will use the carrying amount of the asset that you have given out to measure the asset that you are collecting. Is that clear?
Sir,
Yes.
sir,
Yeah?
in that case, Bob has 120 and he gives away, and then he gets another one for 125. And then in his
Yeah, he
book,
got another one for 125, but
yes.
in his books now, when you are now recording that light vehicle in your in your statement of financial positions under fixed asset, you are going to record it at 120,000 based on the standard.
And then what with that 5,000, it will be a gain, or what happens? Because
no, you are not. That is not your concern, because it is SARS that value this one at 125,000.
Okay.
But the standard recommend that fine, if the fair value is determined, use the fair value of the asset that you are giving up.
Okay. Okay.
But if it is not determined, use the carrying value of the asset that you are giving up.
Giving away. All right.
Yeah.
So, okay, we have to just concentrate on one person here, the books of one person. For instance, Bob Ltd's books only at the moment.
Yes.
Okay.
Yes.
And then the other one, the Z's books, it's how is he also going to note down the transactions? Because he's getting 120 and then giving away 125.
Yeah.
Or is he still going to also record in his books as 125, the one that the same amount as the amount that he gave away? Or
if we are applying the common sense, I think because the fair value of the asset that SARS is giving away is 125,000.
Yes.
So that means his books, he will record, but the standard emphasizes on the company that is acquiring the asset, that is just doing the exchange. Because when you look at, except that because the asset that you have a carrying value of 100,000 and you now record it in your books at 125,000, you Yeah, it makes, it makes no accounting sense.
Mm.
Yeah.
It
So
is
that's
a
why
Bob.
our emphasis will be on Bob now.
Okay. All
Yeah.
right. Okay.
Okay, transaction 2. A machine of Bob Limited with a carrying amount of 920 of 90,000 was exchanged for a machine of YK Limited, which is carried in the YK Limited record at 80,000. The fair values of neither of the machine will be readily determined. The fair value of neither of the machine could be readily determined. Now, how will the Bob measured the amount that is, the machine that is getting from YK?
What
Since
they
there's
carrying
no-
amount?
Is it the carrying amount?
Yes, Bob will be recording it at 90,000. Based on the standard, because we are told that they cannot determine the fair value of those assets. So, and the standard says if you cannot determine the fair value of the asset, then you are going to record it at a carrying amount of the asset given out. Okay.
So in his books, there is no change still.
There's no change, exactly.
Okay.
Transaction 3. A computer network system of Bob Limited with a carrying amount of 160,000 was exchanged for a furniture with a carrying amount of 170,000 in the record of Z Limited. Now, the fair value of the network system cannot be determined readily, as this item is seldom sold in its entirety. However, based on probabilities, the fair value is estimated at 150. The fair value of the furniture is 165 and is readily determinable because an active market exists for this used asset. Okay, a computer network of Bob Limited with a carrying amount of 160,000 was exchanged for a furniture with a carrying amount of 170. Now, the market value, the fair value of the network system cannot be determined, but the fair value of the furniture can be determined at 165. So, what is the value that Bob is going to record the furniture in his book?
I'm gonna try. I think it's 160,000, the carrying amount, because it's not established. It's only estimated price, the 150.
Yeah, you try, but let's look at the condition. The condition says let's go to the conditions. It says you must be able to, the fair value of neither the asset is received nor the asset given up is reliable gathered. Okay, so if the fair value of either of these assets is determined, it means these conditions is fulfilled. Okay, but if neither, he said if the fair value of neither the asset received nor the asset given up is reliably measurable. In both cases, the asset that is acquired is measured at a carrying value. But we can see in this case that one of the conditions, one of the assets is determined, it can be measured at a fair value. So if it can be measured at a fair value, then the issue of carrying value, I don't think is going to come on board. So here I believe that Bob will be able to measure the furniture at 165,000 in his books.
Yes.
Do we agree?
Yes.
Yes, all right. 4.
So to say,
Go ahead.
Hello?
Yeah.
Yes, according to this scenario, it says determine, like it's, where is this scenario? It's if there is a market exist on this situation, so does not necessarily mean that we will take that value if ever there is a existing market.
Yeah. He said they were able to determine the value of the fair value of the furniture because there's an active market that exists for the used asset. But in case that of the computer network system, he said they couldn't determine the fair value because normally they used to sell the entire. He said the value of the fair network cannot be determined readily as this item is seldom, that is, it's rarely sold in its entirety. So that's why but they want to deceive students here. They said, however, based on probability, the fair value is estimated. You are not talking of estimated value now. You are talking of the determined fair value. So if students should be aware. Should be careful of this. We are not using probability. So this is not how to determine. Fair value is the market value. What is obtainable in the market now. So that's why they said the fair value of the furniture is 165 and it's readily determined because an active market exists for this used asset. So they know that is where to just let you know that they actually have a market value for this, a true fair value. Okay, so when that one exists, it actually negate that condition we have, and that will go ahead to measure that particular asset using the fair value. Let's look at transaction 4. Bob Limited exchanged a truck with a carrying value of 200,000 for a similar truck of the same age and condition of Wow Limited. Okay, let me finish reading. I will ask one question. The truck of Bob Limited has blue stripes painted on the side, and the other truck has silver stripes, which is more to the liking of the managing director of Bob. The fair value of the blue stripe truck is 210, and that of the silver stripe truck is 220, which indicates that the silver stripe truck is more popular. Okay. Let me look at this question. But the first, Bob Limited exchanged a truck for a carrying value of 200,000 for a similar truck of the same age and the same condition. Who can tell me, who can interpret this statement for me based on the condition we have, in the standard? This truck, it has a carrying value of 200,000 for a similar truck of the same age and condition. What difference in this truck, as explained in the question, is the stripe, blue stripe and silver stripes? That's all. In terms of age and condition, they are the same. What conditions does this one satisfy in the standard, the one we read above? Does it not look?
Can I say something here?
Yes, go ahead.
It's like when something is on demand and people are liking it, the price will go a little bit high because whoever is selling is going to make a lot of profit, and surely people will buy. In my head, at the back of my head as well.
Yeah. That's good. But what I want us to look at and emphasize on is that this truck, they are of the same age and they have the same condition.
Yes.
The stripe. The stripes now. Those the
colors.
The sticker you put by the side. Mm-hmm. One is blue. One is silver.
Yes.
So, but the same age and the same condition. I think this one is satisfying this condition that it lacks it lacks a commercial substance. The exchange lack commercial substance. You understand me? Because now the question is saying it has the same age and the same condition. If it's the same condition of the same vehicle, the truck you are giving out, and the one you are collecting is having the same age, the same condition, definitely I don't think it's going to give you any additional benefit.
No additional what do you call value?
Benefit, future benefit.
Yes.
You agree? So it satisfies that condition of lacking commercial substance. And when it lacks commercial substance, you have to measure at a carrying value of the given asset. Are you getting it now? You know, now they told us that the fair value of this is this, the fair value of this, this truck, this thing, the fair value of this is this. But it couldn't satisfy the issue of lacking a commercial substance. So, which means the truck will be measured at a carrying value. Is that clear?
Yes.
So, if we look at the solutions, we have answered the questions. We have the delivery vehicle at 120. This one is 90. This is 165.
So meaning the 10,000 difference, it's of no use. It's just a waste of time. I mean, a waste of money.
Yeah, they want us to test whether you understand the conditions you need to take into considerations before determine how you measure those items. Now they said they gave us the fair value of those the trucks, but they have already told us that this trucks lacks commercial substance because the trucks are of the same age and they have the same condition. So it's not going to do anything better. Okay, let's see how far we can go before our time. Definitely. You getting it?
Yeah, I get it because
yeah, all right. I do. Yeah, let's look at another example 6. I'm not sure we'll be able to complete this. We can't use one section to finish this.
Let's try, sir. Let's try. It's long and the time is short.
It's short. Yeah. We will continue. We definitely have to continue with this one next class because we can't. By the time we get to the actual PPE, when you'll be dealing with the comprehensive examples, we need to deal with those ones very, very critical. And that is what you exactly need. All this one is just to, build you up, understand a lot of concepts about the standard and all that. Okay. Inzalama Limited is a medical and pharmaceutical company based in South Africa. Inzala manufactures and distributes indigenous African medicine across South Africa and the rest of the Southern African Development Community region. Inzala has a 30-year end. Okay, on May 1st, 2021, Inzala entered into an exchange transactions with another pharmaceutical company based in Nairobi, Kenya. Inzala agreed to exchange one of its highly specialized packaging equipment for a cold storage delivery vehicle. The Kenya's company's cold storage delivery vehicle was customized and met Inzala's need for the delivery of medications, and thus the exchange of the asset was deemed to have a commercial substance. Okay, the question is confirming to us that this exchange has a commercial substance. So one aspect of the condition is satisfied now. On 1st of May 2021, the packaging equipment had a fair value of 3 million and a carrying amount of 2,100,000, which is the cost is 3 1.5, the accumulated depreciation is 1.4. Now, on 30th June 2020, accumulated depreciation on the packaging equipment amounted to 1 million. Nzala had purchased the packaging equipment on 1st of January 2016, and it was used in the manufacturing process since the acquisition thereof. The cold storage delivery vehicle had a carrying amount of 2.5 million, cost minus accumulated of 500,000 on exchange date. As at the 1st of May 2021, the fair value of the customized cold storage delivery vehicle could not be readily measured. It can be assumed that all amounts provided are correct. It can be assumed that all amounts provided are correct. Now, we were told that this has a commercial substance, but the vehicle cannot be readily measured. Write a memorandum addressed to the Chief Financial Officer explaining the cost at which the cold storage delivery will be recognized within the accounting record of Nzalama Limited. Please note your answer must comply with the requirement of the IFRS. So you have to write a memo to the Chief Financial Officer telling him at what price, at what cost should the cold vehicle, they are exchanging, what they are getting is the cold delivery vehicle, which we are told that the fair value is not readily available, but though it has a commercial substance. So this is, you write a letter to the Chief Financial Officer of the Alama, the cost at which the cold storage delivery will be recognized. So what you need to do is to, first of all, because you are the accountant, he is the Chief Financial Officer, you want to let him know, tell him the details of the standard in accordance to IS 16 paragraph 24, an asset acquired through an exchange transaction shall be measured at a fair value of the asset given up, unless the exchange transaction lacks commercial substance, or the fair value of neither of the asset received nor the asset given up is level measured. So if the acquired item is not measured at a fair value, its cost is measured at a carrying amount of the asset given up. So the exchange transaction has commercial substance, and therefore the cold delivery should be recognized at the cost of 3,000. The cost of 3 million, which is the carrying amount of the cost of on first the packaging equipment at the fair value of 3 million and its carry amount of this. Okay. You can see the asset given up is the packaging equipment with a fair value. With a fair value of 3 million. Why? Because the asset has a commercial substance. It has the exchange has a commercial substance. So you will recognize it at the fair value of the asset given up. Then we talk about measurement after recognition, the cost model, evaluation model, the depreciations. So just go through all these details in the paragraphs. Where is depreciation recorded? Please go through all these details. Let's concentrate on the workings. Now, I think, okay, example 7, cost of equipment. Now, we are going to learn the method of depreciation here. You will have read it in those theories. But let's quickly use this example to demonstrate them. We have the cost of equipment 1st of March 2013. The residual value remain unchanged, 20,000. Useful life is 4 years, 3 years. The year end is 28th February. Calculate the depreciation charge according to straight line method, diminishing balancing method, assuming annual rate of 58.28% per annum. Then use the sum of the digit method, sum of the unit method. So these are the depreciation methods, okay? We have the straight line method, we have the diminishing method, we have the sum of the unit method, okay? I've explained straight line method and we have also used diminishing balancing method. We have not used the sum of the unit method, okay? But let me see whether the information here cover that of some of the unit method. For the straight line method, I've said the cost less residual value, then divided by the useful life. So all the informations we have it here. The cost is 500,000. The residual value is 200,000. I mean 20,000. So it's 500,000 less 20,000, then divided by 4 years, which is the useful life. Okay, but if it is diminishing balancing method, you just apply the rate straight off on the at first on the cost, then later on the carrying value. Okay, for the straight line method for year one, when you use the 500,000 minus 20,000 divided by 4, it is 120 annually for 4 years. Okay. Annual depreciation is 120. The carrying amount, you can see the carrying amount. 120 minus, 500,000 minus 120, 380, 260, 140, 20. Diminishing balancing method. You just apply the percentage. At year one, you apply it at the cost. Okay? The cost is 276. The carrying amount, when you remove 276 from 500,000, you have 223. This is the carrying amount. Then the carrying amount is what we are going to apply the percentage on the following year. The other year, the carrying amount. Okay? Then there will be the balance, 19,999, this is almost 20,000. Okay. The carrying amount at the end of the 4 years must be equal to 20,000, which is the residual value. The difference is due to the rounding errors. Note, when calculating depreciation with diminishing balancing method, you do not subtract the residual value from the cost because the residual value is accounted for in the rate. Okay. We are not subtract, you don't subtract it. You only do that for straight line method. Okay. Now, some of the digit method, the total number of years or the number of the total numbers of the units. Okay. The sum of digit method, you see how you go about it here. We have 4 plus 3 plus 2 plus 1, which is equal to 10. How do I explain? Let me explain this one. We see that the sum of the unit method, the year, we have a total number of years, which is 4 years. Okay, that is 4 years. And that 4 years, the next year will be 3 years. Other year will be 2 years. After 4 years, when 4 years is gone, the next year is 3 years. The other year is 2 years. The other is 1 year. So you put, that is how you just put, we have the 4 years. After 4 years, we have the 3, we have the 2. Like what you see here, you see that year 1 is going to be 4. Year 2, the year will have dropped to 3. Year 3, it will not remaining 2 years to go. Year 4, That's the 1 year to go. That's 1 year. So you add them together, which is equal to 10. And this is how you do the calculation. For year 1 to be 4 divided by 10, multiplied by 500 less the residual value. In the sum of digit unit method, you also remove the residual value. But this is how you do the calculations. Okay? And this is very, very common. I mean, this is very, very uncommon. So I'm not sure there's any of such in any of the comprehensive examples. I'm not sure. Okay, so in any of these methods above, the figure or the amount shall be reviewed at least at each financial year if the expectation differs significantly from previous estimate. Okay. Then we talk of the recognition. Okay.
Sorry,
yeah?
Before you go any further, can I ask a question? This method, the straight line method, diminishing method, I mean, with the note at the bottom, are they trying to say to us they are just only showing us how the diminishing balance method works and straight line method works? What I mean is that every time, whenever the question comes, we must know that when it comes to straight line method, they will always give a residual value. And then in a diminishing balance method, even if it's not there, we can still just calculate without.
Yeah. For straight line method, what you need to know is the cost less residual value divided by the useful life. But that does not mean that the questions will always contain residual value. But they tell you that if the question say use a straight line method, in fact, the moment the question has a useful life, because when it comes to reducing balancing method, they may not necessarily mention the useful life may be there anyway to know to determine the how many years we are calculating. But for straight line method, if they didn't mention residual value, since you know the calculation, it just means that it will be that it will be cost minus 0 because there's no residual value, then divided by useful life. You get it? So it's not that every questions will have residual value. If they tell you there's no residual value, but you must use straight line method, you still go to divide the cost divided by 4.
Oh, okay. All right. Okay, yeah. I get it. I hear you.
Okay. The recognition, the carrying amount of PPE items shall be recognized on disposal or when the future economic benefits are expected from its use or dispose. When you dispose an asset, when you dispose an asset, the asset is not supposed not to continue to be in the books of the company. So it has to be derecognized. We take it out. We take it out. You are going to see it in an example. You will take it out. That is under the recognition. We will take it out. Once you have disposed the asset, then we will determine the value at the carrying value on disposal or at disposal. We determine the carrying value at disposal, and such will be recognized from the books. Okay, we can go through the theories, but we are going to see it practically when we tackle an example. Okay, let's try to do example 8 before we will close for the day. A Limited enter into the following 2 transactions in respect of PPE items during the year ended 31st December 2012. Machine 1, with an original cost price of 300,000 on 1st of January 2010, a residual value of nil. Can you see now? A residual value of nil. And a carrying amount of 180,000 on 1st of January 2012 was sold on 30th June 2012 for 210. The payment will only be received from the buyer on 30th June 2013. You can see when you talk of PPE, you have a lot of dates. So you just have to be mindful of which of the dates that is relevant to your calculation. Machine 2, with the original cost of price of 500,000 on 1st of January 29, the residual value of nil and the carrying amount of 200,000 on 1st of January 2012 was withdrawn from use on 30th April 2012 after Earth Inspector prohibited the further use of the asset due to irreparable pollution problem. The asset cannot be adjusted to secure further use thereof, which make it resale impossible. Both machines are depreciated at 20% per annum on straight line basis. The current interest rate for asset financing is 12% per annum required. Calculate the profit or loss on the recognition of the two assets to be shown in the statement of profit or loss and other comprehensive income and any other relevant item. Prepare the journal entry for the recognition of the machine. So this example is just to also give us understanding of how to deal with recognition. Okay. Now, let's look at machine 1. It has a cost price of 300,000. There's no residual value. And the carrying amount as at 1st of January 2012 is 180,000, the carrying amount, and was sold on June 2012. The carrying amount of this asset of January 2012 is 180, but it was sold. Now, to determine the profit or to determine the value at which this asset will be recognized in the books, you have to determine the carry amount at disposal. We were given the carry amount of 1st of January, but it was sold on 20 June. So we have to determine what is the carry amount of this asset as at 30 June. Okay? That is what we do for machine 1. Once we determine that, you know how to determine the carry amount now. The carry amount is to remove, cost minus accumulated depreciation will give you a carry amount. So when you have a carry amount again and you deduct depreciation again, you have another carrying amount. So what we need to do now is to determine the depreciation of this asset up to 30 June so that we'll be able to determine the carrying amount of the asset sold at the date of disposal. So the same thing with machine 2. So what I'm emphasizing here that when you are talking of disposal and the recognitions, the carrying amount at that point of disposal is what you will aim at. Once you determine the carrying amount at the point of disposal and compare it with the amount that the asset was sold, then you'll be able to determine the profit, whether there's a profit or not. Okay, so let's quickly look at the calculations here. Machine 1, the proceed on disposal. The carrying amount, I will explain the issue of proceed on disposal shortly. Let me just show you what I'm talking about. The carrying amount on the date of disposal. This is the 180,000 is the carrying amount at 1st of January. Now you have to calculate the depreciation for 6 months because it was disposed on 30 June. And this is 1st of January. So it means this asset still exists up to June. So you have to calculate the depreciation up to June. And you know the depreciation is straight line method. So, and the cost, when you talk of straight line method, you are talking of the cost less depreciation value. But there's no residual value now. So the cost multiplied by now they even give you in percentage. Not they even give you useful life. They give you in percentage, but the question says it's a straight line basis. So you multiply 20% by 300,000, which is the cost. Then, and you have to do the, you have to determine the 6 months. Because that one is for 1 year, 6 months, okay, to determine the carrying amount, which is 150,000. To carry that's the carrying amount. Now, there's this issue of the current interest rate for asset financing is 12% per annum. So when you in your questions, when you see something like this, it is to prompt you to know that, look, it's like you need to determine the value of this asset based on what do you call it? Future value. Now we were given that it was sold for 210 on 30th June 2012. It was sold for 210. The payment would this is what I'm looking for. This is what will prompt you to know the payment will only be received from the buyer on 30 June 2013. The asset is sold now, but you won't receive the payment on the 1 year after. Okay, 1 year after. Now the transaction is now, and you have to update your financial record now, but you won't receive this money. That's why the issue of interest. So if the guy is not paying now, definitely is going to pay with interest. Now, it is your duty to determine the present value of this cash you are receiving in 1 year's time. You are receiving 210 in 1 year's time, but what is the present value of this cash now? That is why you have to pick up your financial calculator and say, okay, the number is 1 year, 1 year time, 2012 to 2013, June 2012 to June 2013, which is 1 year. The future value you are expecting is 210. The future value you are expecting is 210. The interest is 12%, which is given in the question. Then compute the present value. So please, you use your financial calculator. So what you need to do is to now know how to calculate present value, future value from your commercial calculator. So when you slot in all these variables, the number of years given is just 1 year. The future value you are expecting is 210, and the interest rate given in the question is 12%. You calculate your present value, which is 187,500. So the money you are expecting in 1 year's time, the value of that money now is 187,500. That is the value you are going to compare the carry amount at the date of disposal with. So the carry amount at date of disposal is the 180,000, which is the carry amount as at 1st of January. You now calculate the depreciation for 6 months and remove it from there. You now see that the carry amount at the date of disposal is 150. When you compare 150 with 187, that is the present value of the amount you are expecting. The profit on the sales of that machine will be 37,500. Will be 37,500. Okay, so the same thing you will do for machine 2. Machine where there's no any delay in payment in machine 2. We are told that the equipment, they couldn't sell it. They couldn't sell the machine. They just withdrew the machine from their record, and it was withdrawn on 30th April. The carrying amount of that machine of January is 2012, but was withdrawn from use on 30th April. It means you have to determine the carrying amount of this particular vehicle at 30th April. That's the value that you will take out from your record. Okay? So the proceeds on withdrawal of use, nil. Carrying amount on the date of withdrawal. You calculate the carrying amount up to April, which is this. The loss on the withdrawal is this. Because we were told that they were unable to sell the vehicle. They were unable to sell the vehicle. So the carry amount is this. So this is your journal entries. Just go through your journal entries you will raise. Then you will now discuss revaluation model. Okay. So definitely we are unable to finish this now because we need to go through all these rudiments before we tackle comprehensive examples. Okay. I will discuss with the coordinators that we were unable to finish. It's a very, it's a very large topic. So we will continue next week. Okay, guys, any question? So next week.
This looks very interesting, Sam. Besides questions, it looks very interesting, but I think one needs to go back and read and understand it deeper.
No, it's quite, it will be, no problem. But I will take comprehensive, you guys will enjoy it. No problem. Now that you are able to, before next class, you can go through what we have done so far so that you are familiar with, how those things goes. There's no problem. Next week we start with revaluation model because sometimes after initial measurement, the subsequent measurement you can either continue to measure at a cost model or as a revaluation model. So we'll discuss revaluation, take example on that before we jump into comprehensive examples and exercise.
So the class is the same time next week.
Yeah, same time next week, Tuesday. Next same time.
Okay.
Thank you, guys.
Thank you, sir.
Yeah.
Thank you.
Thank you. Bye.
Bye.
Bye-bye. Thank you. Bye, everyone.
Bye. Thank you.
Thank you.
Bye, guys.